Coke versus Pepsi. It's one of the most iconic rivalries in history, right? And it's usually settled with a blind taste test. But today, we're skipping that. We're going to look at this classic showdown from a totally different angle, from the investor's perspective. So let's put our taste preferences aside, put on our investor hats, and figure out which of these absolute titans is the smarter buy. Right, forget which one you prefer with your pizza. The real question for us is which one of these giants actually belongs in your portfolio. We're about to dive deep into a fantastic analysis from Save Invest Compound to see which stock, Coca-Cola or PepsiCo, truly passes the value test for a long-term investor. All right, first up, let's get down to brass tacks. What do these companies actually do? Now, they might seem like two peas in a pod, but under the hood, they are running two very, very different playbooks. This is the tail of the tape for their business models. So this is really the core of it all. The fundamental difference in their strategies is fascinating. Coca-Cola, you see, operates like a lean, capital-light machine. They don't really bottle most of their own stuff. They just focus on the brand and sell that magic syrup to their partners, which lets them rake in incredible profit margins. PepsiCo, on the other hand, is a full-blown empire. They're fighting a war on two fronts, beverages and snacks, with absolute powerhouses like Lay's and Quaker. So it's focus versus diversification. Okay, so with those different models in mind, let's pop the hood and check out the financial engines. Which company is running more efficiently? And, which one has the more durable financial foundation? Let's get into the numbers. And right off the bat, Coca-Cola puts up a monster number, a 43% return on equity. Now, what does that actually mean? Well, it's a key profitability metric, and it tells us that for every single dollar shareholders have invested in the company, Coke is just exceptionally good at turning that into profit. It's a huge sign of a very, very efficient business. And would you look at that, PepsiCo is right there with a 42.8% ROE, nearly identical, you might think. But, and this is a big but, this is where the deep dive is so important. A big reason Pepsi's number is so high is its use of debt, what we call financial leverage. You can think of it like this. They're using borrowed money to generate profits. That can amplify your returns, sure, but it also adds a pretty significant layer of risk. This table really lays out the trade-offs perfectly. First, look at that profit margin. Coke's 27% just blows Pepsi's 8.8% out of the water. That's the power of that concentrate model right there. But then your eyes go to debt to equity. The analyst flags Pepsi's ratio of over 250% as a major concern. That's way higher than Coke's 140%. And finally, let's talk about free cash flow, the actual cash left over. Here, the story flips. Pepsi is a cash machine, generating over $8 billion. Meanwhile, Coke's was recently negative, which is definitely something the analyst wants us to keep an eye on. So we know how the businesses are performing, but that's really only half the story for an investor, isn't it? The other, arguably more important half is the price you pay. So what's the price tag on these giants? Let's check out the analyst's calculation of each company's intrinsic value. And here's the kicker. At the time this analysis was done, both of these stocks were trading at a premium to what the analyst believes is their real underlying value. The analyst pegs Coke's true value somewhere between $64 and $68, but it was trading over $75. Same story for Pepsi, value calculated around $138 to $145, with a price tag over $150. In both cases, there's what we call a negative margin of safety. The market price is higher than the estimated worth. Okay, knowing they're a bit expensive right now, let's look to the future. What are the potential paths forward for these two? We'll use the analyst's SWOT scores and scenario analysis to get a feel for what could happen next. First up, Coca-Cola with a very solid 7.15 out of 10. And you can see right there on the chart why. Just look at that strengths slice. It contributes a massive 2.7 points to the total. That's almost entirely driven by that world-class, iconic brand and its unbelievable global distribution network. PepsiCo comes in just a little bit lower with a total score of 6.8. Now, its diversification is a huge strength for sure, but you can see that the weighted score for weaknesses is a bit higher at 1.5. And that's a direct reflection of the concerns we've been talking about, that high debt load and the constant pressure on its profit margins. I love this kind of scenario analysis. It gives us a great look at the whole range of possibilities. So in a bear case, think low growth, Coke's value could drop to $55 and Pepsi's to $120. But in a bull case where things really take off, their values could soar to $80 and $165. It just goes to show you how sensitive their valuations are to even small changes in growth and margins. Okay, now this is where the analysis gets super practical for us as investors. Let's say your personal goal is to achieve at least a 9% return per year. The analyst crunched the numbers to find the exact price you'd need to buy these stocks at to hit that target. Let's see what those magic numbers are. And here it is, the actionable data. To get that 9% return, the analyst calculates you'd need to snag Coca-Cola at around $64 for a long-term hold. For PepsiCo, that target buy price is around $135. Now compare these numbers to the market prices we saw earlier, and you can see exactly why the analyst believes they're currently a bit too rich for that specific return goal. So we've looked at the business models, we've checked the financials, we've sized up the valuation, and we've peered into the future. Now it's time to bring it all together for the final verdict from the judges' scorecards.
And this chart just neatly summarizes the whole trade-off, doesn't it? On the risk scale, where higher is riskier, PepsiCo scores a 6.8, a little above Coke's 6.2, and yep, that's largely because of its debt. But when we flip over to the opportunity score, Coca-Cola just edges out Pepsi. So the final takeaway from the analyst here is that Coke is seen as slightly less risky with a little bit more upside potential.
So what is the final call? After all of that, it's a unified verdict for both companies. Hold. The analyst concludes that at their market prices back when this report was written, neither stock was a compelling buy. The recommendation is pretty simple. Be patient, wait for a better price, or, as they say, buy on weakness. All right, let's wrap this all up. Think of Coca-Cola as your high-quality, high-margin defensive anchor. It offers incredible stability, but you've got to pay a premium for it. The analyst says it gets really compelling below $65. PepsiCo is more of a hybrid play, diversified for income and growth. It's an absolute cash flow powerhouse, but it is held back by that debt. The compelling buy price for Pepsi? Below $140. At the end of the day, the choice is yours, and it really depends on what you're looking for. Do you prefer the focused, high-margin fortress that is Coke, or the diversified, cash-generating power of Pepsi? I'd love to know which one you think is the better long-term bet, so let me know down in the comments. And hey, while you're there, tell us which stock you want us to break down next.